Welcome to today's session. It's really great to have you with us. If you're designing a life around financial independence or, exploring a nomadic lifestyle, you probably spent a lot of time thinking about passive income.
Oh, absolutely. It's the core of the whole lifestyle.
Right. So our primary mission today is to explore the case study by Blueprint to Escape. And this looks at a very specific 36-month window from March 2023 to March 2026.
Yeah, that 3-year block.
Exactly. We're going to compare two distinct pathways for generating that passive income. On one side, we have do-it-yourself or DIY real estate rentals, and on the other, equity investing through multi-sector and index ETFs.
And it's a highly relevant comparison right now. I mean, the goal is to look at the data from the past 3 years objectively. We want to see which approach actually provided a more reliable, stress-free monthly cash flow over that period.
Exactly. And before we dive into the numbers, I want to establish our tone for today. We're keeping things mild, professional, and grounded entirely in the data.
Right, no hype.
No hype at all. Our objective is absolutely not to label real estate investing as bad or, to tell you to go sell all your properties tomorrow. Real estate has built incredible wealth for millions of people.
It has.
We are simply offering a data-backed alternative perspective for you to consider as you build your own path to early retirement.
That's a vital distinction to make right up front. So to frame the conversation, let's lay out the specific parameters from the case study by Blueprint to Escape.
Yeah, let's hear the baseline.
The analysis starts with a baseline initial investment of $400,000 USD, or the equivalent of $540,000 CAD, made exactly 3 years ago. Now, crucially, this analysis does not factor in inflation, and it does not assume that you are reinvesting your dividends.
Okay, I'm really glad you brought that up because at first glance, ignoring dividend reinvestment sounds like a massive mistake in any financial model. Why would the study leave that out?
It's a practical choice. The core goal of this analysis is evaluating how to generate a reliable monthly paycheck that you can actually live on today. If you're pursuing a nomadic life design, or you've retired early, you're using those dividends to buy groceries, pay for flights, or cover your Airbnb.
You're spending it.
Exactly. You can't let that money compound in a brokerage account if you physically need it to live.
That makes a lot of sense. You can't eat a reinvested dividend. Real quick, before we unpack the psychology and the data, we'd love to hear from you. Please post any comments or questions you have down below.
We always read them.
We do. And if you want more content centered around financial independence, passive income, early retirement, and nomadic life design, just hit that subscribe button. Also, definitely look out for the monthly portfolio release.
That comes out around the 20th of each month.
Right, the 20th. It's a really great way to see these concepts playing out in real time.
So let's begin where the study begins, the psychology of real estate. Why are we, culturally, so deeply attached to owning physical property?
The cultural affinity is honestly just staggering. The case study highlights a statistic out of Canada that paints a perfect picture of this.
The realtor stat.
Yes, the realtor stat. As of 2026, Canada has roughly 160,000 licensed real estate agents for a population of about 41 million.
Which is wild.
It is. That means 1 out of every 256 residents is a realtor. In Ontario alone, there are 90,000 agents. You practically can't go to a dinner party without running into one. It perfectly illustrates our massive cultural bias toward property.
It really does. And the case study by Blueprint to Escape calmly breaks down the behavioral science behind this. It outlines 7 key psychological drivers that explain why our brains heavily prefer property over stocks.
Let's go through those. What's the first one?
The first is tangibility. Property is physical. You can touch the brick, you can walk through the door, inspect the roof. That physical presence heavily reduces the abstract fear that people experience when looking at numbers flickering on a brokerage screen.
I completely get that. If the stock market drops 10% in a week, it feels like your money just vanished into thin air. If your house price drops 10%, the house is still sitting right there. It feels safer.
Precisely. And that physical reality feeds directly into the second driver, the illusion of control. When you're a landlord, you can choose to renovate the kitchen to increase rent. You can paint the walls. You can vet your own tenants.
You feel like the boss.
You feel like the captain of the ship. But as an ETF investor, you are just a tiny, seemingly helpless shareholder riding the waves of a massive global market.
Though, to be fair, I've always thought illusion is the perfect word there. Sure, you control the property right up until the water heater floods the basement at 2 in the morning on a Sunday.
Oh, yeah?
Then suddenly the property is controlling you.
That's the reality of the DIY approach, certainly. but the feeling of control remains a powerful draw anyway.
Right, what's number 3?
The third driver deals with slower feedback loops. Real estate prices adjust slowly. You don't have an app on your phone pinging you every 5 seconds with the updated real-time value of your duplex.
Thankfully.
Right, stocks update constantly. This triggers loss aversion, which is a behavioral finance concept, where the psychological pain of losing money feels roughly twice as intense as the joy of gaining that same amount. Stocks force you to confront that pain on a daily basis.
Which is exhausting. And I assume that leads to the fourth driver, which the study calls the cash flow narrative. The idea that my property pays me a rent check every single month is a very comforting story. It just feels more concrete than looking at an abstract dividend yield, even if the math works out to be exactly the same.
It does feel more real to people.
Yeah.
And it ties into the fifth driver, wealth-building identity.
Okay, what does that mean?
Buying property is socially framed as a savvy, proactive business move. You're negotiating a mortgage, utilizing leverage, buying an asset. It aligns with an identity of being a smart entrepreneur. Conversely, simply buying an index ETF and letting the broader market do the work feels entirely too passive for some people's egos.
You want to feel like you earned the return through hard work. And that brings in the sixth driver, social proof. We all grew up hearing phrases like, they aren't making any more land, or real estate only goes up. Meanwhile, mainstream headlines treat the stock market like a volatile casino. The familiarity bias toward property is just baked into us from a young age.
And the seventh driver might actually be the most impactful of all. Commitment devices.
Meaning you're locked in.
Meaning the high transaction costs and the sheer illiquidity of physical property actually protect investors from their own worst impulsive tendencies. Selling a house takes months of effort, which physically prevents you from panic selling during a bad economic week. With an ETF, acting on fear or greed takes one click on a smartphone.
So the psychology heavily favors that brick-and-mortar house. It feels safer, you feel more in control, and it stops you from making rash decisions.
Exactly.
But when you strip away the feelings and just look at the raw bank statements from the last 3 years, a very different picture emerges. Let's look at the United States market comparison first.
Right. So sticking to our parameters, we start with a $400,000 initial investment in a DIY two-bedroom rental property in the U.S. Over the 3 years from March 2023 to March 2026, the data shows that property appreciated 12.5%, bringing its capital value to $450,000.
Okay.
It also yielded 6.0%, which translates to $2,250 a month in rent.
On the surface, a 6% yield and some steady appreciation sounds like a solid, reliable path to financial independence.
It does, but that 6.0% figure requires a crucial caveat from the case study by Blueprint to Escape. That is a gross yield. It entirely ignores the hidden costs that part-time landlords face.
The hidden costs are always what get you.
Always. We're talking about roughly 1% for property taxes, 0.5% for insurance, 1 to 2% for maintenance reserves, 5 to 8% lost to vacancy periods between tenants, and property management fees if you use them.
That adds up fast.
It really does. Those expenses typically eat up 25% to 35% of that gross rent. So your true net yield is much closer to 4% to 6%. Geographically, you might see 6% to 8% in the Midwest, but only 3% to 5% of the coasts.
That significantly changes the math if you're actually trying to live off that income. A 4% net yield on $400K is only about $1,330 a month in actual profit.
Okay.
So let's compare this to the equity alternatives. First up, we have real estate ETFs using VNQ as the U.S. benchmark. Over the same 3 years, a $400,000 investment in VNQ grew 12.2% to $448,720 and provided a 3.7% yield.
And it's important to clarify what VNQ actually is. You aren't just buying residential houses. You get exposure to booming technology infrastructure. It holds data centers, cell tower networks, and Amazon warehousing logistics companies like Prologis.
Oh, wow.
But even with that modern diversification, the yield remains relatively modest compared to direct real estate ownership.
Then we move to broader markets, looking at high-dividend equities, using the SCHD ETF as the benchmark. This option saw a massive 27.8% price increase, bringing the principal up to $511,040. And more importantly, for our cash flow goal, it generated $4,318 in monthly cash flow.
That is a substantial jump in both capital appreciation and monthly income. You're looking at a much higher standard of living there compared to the rental.
But where it gets truly fascinating is the covered call equities category, specifically the SPYI ETF. The capital appreciated by 11.8%, putting the value at $447,040. But it produced a staggering 12.0% yield, resulting in nearly $4,000 a month in cash flow.
That yield is hard to ignore.
Now, a 12% yield sounds amazing, but there's always a catch in finance. Could you explain what a covered call ETF actually does?
Absolutely. The simplest way to understand a covered call ETF is to think of it as renting out your upside. The fund holds the underlying stocks, but it sells options contracts to other investors, giving them the right to buy those stocks if the price skyrockets. By selling those contracts, the fund collects a premium, basically cash, right now, which it passes on to you as a high yield. The catch is that if the market had a massive, record-breaking bull run, your growth is capped because you've traded away that peak upside in exchange for guaranteed cash today.
Okay, so it's a deliberate trade-off. You're giving up the chance of your portfolio doubling overnight in exchange for a massive, reliable paycheck right now, which, if you're a nomad trying to pay for your lifestyle today, is a trade-off that makes a lot of sense.
Exactly. The takeaway from this U.S. data segment is clear. The high dividend and covered call equities provided nearly double the usable yield of the physical property. And they did it without the mental stress of what the study calls the tenants, taxes, and toilets problems.
The dreaded 3 Ts.
Exactly. You achieved a superior monthly income without having to manage physical infrastructure or deal with unexpected maintenance runs.
It's a very compelling alternative. Now, let's shift our focus north and look at the Canadian market comparison. Based on the case study by Blueprint to Escape, we're evaluating a $540,000 CAD base investment made in March 2023. Over the last 3 years, a DIY 2-bedroom rental in Canada saw incredibly flat price appreciation of just 2.5%, bringing its total value to $553,500. It produced a 5.2% gross yield, which is roughly $2,306 monthly.
And to give that regional context, average gross rents for 2-bedroom units vary wildly across Canada. In Montreal, it sits around $930. In Toronto, it's about $2,700, and in Vancouver, you're looking at over $3,100.
Huge differences.
Huge. However, just like the U.S. example, those gross numbers are heavily dragged down by taxes, maintenance, and condo fees. The net cash in your pocket is much lower.
And a 2.5% appreciation over 3 years is basically just treading water. So how did the Canadian ETF alternatives stack up against that $2,306 monthly check?
The contrast is striking here. Let's start with Canadian REITs using the XRE ETF. This index reflects the true domestic physical market residential, office, and retail properties. Because the Canadian real estate environment has faced high interest rates and sluggish growth recently, XRE actually lost 10.1% in price over the 3 years, dropping your principal to $485,460. It offered a 4.8% yield, meaning the total return was incredibly weak.
So trying to buy Canadian property through the stock market actually performed worse than owning the physical asset in this specific window. That's a point for the DIY landlords.
It is.
But what happens when we step outside of real estate entirely and look at the broader Canadian equity markets?
That is where the narrative shifts dramatically. High-dividend Canadian equities, represented by the SPYI ETF, entirely outpaced physical real estate. The initial investment saw a 41.0% price increase, growing your principal to $761,130. At the same time, it provided $2,531 in monthly cash flow.
So you're getting slightly more monthly cash than the physical rental, but your actual net worth grew by over $200,000 without lifting a hammer.
Without dealing with a single tenant.
And then we look at the covered call equities in Canada, specifically the HDIV ETF. It showed a 38.7% price increase, bringing the principal to $749,142. But the yield was a massive 10.0%. throwing off $6,243 a month.
Think about that difference. The physical Canadian rental grossed $2,306 a month before expenses. The covered call ETF netted $6,243 a month.
If you're sitting on a beach in Portugal or simply trying to cover your living expenses in early retirement, the difference between $2,300 and $6,200 is completely life-changing. That isn't just extra spending money, that entirely shifts your standard of living.
It's a remarkable difference in lifestyle funding. And it's vital to point out that these ETF figures are net of standard management fees, which generally range from 0.1% to 1.5%. Even after paying the fund managers, the equity return heavily outweighs the DIY rental. For someone relying on that monthly paycheck, the mathematical advantage of the equity portfolio over the last 3 years is undeniable.
It really is. So let's summarize the core lesson we're looking at today. Real estate offers very powerful psychological comforts. That tangibility, the sense of control, and the cultural social proof are all very real benefits that let people sleep well at night.
And we shouldn't dismiss those.
No, not at all. But when we isolate the data from the last 3 years, the reality is stark. A DIY rental property barely matched a safe, high-yield dividend ETF in total return, and it fell drastically behind covered call ETFs when it came to generating actual, usable monthly cash flow.
The psychology naturally draws our brains to the physical property, but the math, at least over this specific time frame, heavily favors the liquidity, the lack of maintenance, and the high yield of the stock market.
And I want to reiterate our tone here today. This analysis is not meant to be an attack on real estate. Owning property is a fantastic way to build wealth for many people. Our goal is simply to empower you with an alternative, data-driven perspective. It's about optimizing your personal journey to financial independence by understanding all the tools available to you.
Knowledge is only valuable when you can apply it objectively. Understanding both the mathematical realities of the market and your own psychological biases is the key to designing a financial life that truly works for your specific goals.
We'd love to hear your take on this. Please drop a comment below and let us know your favorite income strategy. Are you someone who prefers the tangibility and control of real estate, or do you lean toward the passive, high-yield nature of ETFs? And remember to subscribe for more insights on passive income, nomadic living, and early retirement. Finally, keep an eye out for our portfolio release, which we put out around the 20th of the month.
Before we go, I want to leave you with one final provocative question to ponder on your own, building on everything we discussed today.
Let's hear it.
We learned earlier that the illiquidity of a physical house acts as a powerful behavioral safety net. It physically stops us from panic selling during a downturn. If ETFs clearly win on the math and the yield, but they fail on the psychology because they're simply too easy to trade on a whim, is the ultimate financial strategy simply buying high-yielding ETFs and then intentionally finding a way to lock yourself out of your own brokerage account so you can't touch them?
That is a brilliant thought to end on. If you can automate the discipline, you might just win the game. Thank you for joining us for this deep dive into the data. We'll see you next time.